So, nice to be back in Moscow. I guess when I prepared for this trip, it is the first time in 10 years where the economics numbers for Russia is actually improving. So thank you for making it easier for me to comment on Russian economics. I will do a quick presentation of the global macro picture because there's 2 or 3 things I want to point out. And those 2 to 3 things, of course, will have a severe impact on the Russian economy. But knowing you guys, you want to talk about the Russian banking system, you want to talk about oil, you want to talk about gold, you want to talk about elections, you want to talk about sanctions from the US. So don't worry, you'll get all the chances in the world to have my silly comments on those as well. I'm going to skip this in the first part. So I think in terms of economics models and the way we interpret economics, we are at a crossroads. In the US, Federal Reserve, in Europe, the ECB, and in Japan, the Bank of Japan continues to insist there is a correlation between the labor market and inflation, and that, of course, is the Phillips curve. What is interesting is that even inside the Federal Reserve, their research paper is showing there is 0 correlation between the models trying to predict inflation and the labor market. So what we see right now is a central bank, as late as last night, insisting that the lack of inflation in the economy is transitory. It's coming back, in other words. I will argue today that inflation is never coming back in the way we see it. And the reason for that, of course, is primarily technology. The other thing that is very significant is that think about how we were taught economics. We were taught economics, we look at inflation, GDP, stock market values, PMI, surveys, and everything else. But everything we look at is actually behind what is called the economy. I've been an economist for 30 years, and I understand less about the economy than I did 30 years ago. And I think if any economist is honest, he has to agree he also understands less about the economy than he did 30 years ago. What is interesting is that classically, we take what comes out of the economy, which we don't understand, then we make a model and try to fit it and put it back into the model as a prediction. But it makes no sense, because in a timeline, the economy will also always lead those numbers you're trying to interpret. In other words, we are taking lagging indicators, making them predictive, and putting them back into the model. No wonder that economists always get everything wrong. So there's a new way of looking at this, which UBS, me, and a couple others has done, and it's saying that, okay, we recognize we don't understand what is going on, so why don't we just look at what goes into the model called the economy? And that, of course, is the price of money, the quantity of money, and inflation as measured as the price in energy year-over-year change. And that is the most honest way to look at things, because that gives you the ability to look at what's going on with the price of money. Clearly right now, every central bank except for the Russian is looking to increase interest rates. On the quantity of money, I have a very bad message for you that you'll see in a minute. And in terms of energy, we are pretty much flat year over year in oil prices. We started the year with oil prices being up 25 to 50%, and now year over year we are flat. So there are no new inflation coming, unless, of course, we go much higher in oil prices. Why is this important? This is important because the global credit impulse, which is the change of the change in credit, and I know it sounds complicated, but really what it is think about it like this. In China right now, the amount of credit is still expanding, but the speed at which this credit is expanding is actually decelerating massively. So the global impulse is important because we have figured out in terms of quantitative analysis that the credit impulse leads the real economy by 9 months. So if you know where the credit impulse is going, you have a pretty good understanding of where the global growth and inflation picture is going. And I can sort of prove this to you backwards, but let me first say that the recent drop we've seen in the global credit impulse is the second largest drop in the history of this chart. The largest one was in 2007, 2008. So right now we have the second biggest slowdown of credit facilitation in the world. The speed at which we create credit has gone negative and massively negative, primarily driven by China, but also now, of course, incoming the US and Europe's tapering, which is being introduced. To show you how it works, I can actually, as I said, prove how it works the other way around. Does anyone remember first quarter 2016? The worst start to the year we've had in equity markets in many, many years. What did the central banks do in the world? They did a massive expansion of the credit impulse to meet this slowdown of economic activity. So if it leads by 9 months, so this is Q1. In Q2 and Q3 last year, the credit expansion was massive. Add 9 months to April, and you get January 2018, right? 2017, oh sorry, we are talking 17. So in January 2017, Trump was voted president. He was immediately saying that the market and the credit facilitation and everything was better because of him. The reality, of course, was this is a story that was born because the first quarter was so bad. It was met by a massive amount of credit expansion, and it was coming to fruition. It was coming through the economy in January, February, and March of this year. So we economists, the second most stupid population in the world, only more stupid, of course, is the politicians. We insist on using the wrong model, first of all. Secondly, what we do is we take the intermediate future and we extend it into the intermediate past and we use it to predict the intermediate future. So we think everything is linear, we think everybody is rational, we think everybody knows what we are doing, even though we don't even know ourselves what we are doing. And that is why all the central banks right now are calling all clear, things are improving. The Russian government wants to spend money they don't really have. The Danish government wants to spend money they don't have. The US government wants to spend money they don't have because things are good. But we know that unless something else happens in the world, then the credit impulse is going to be a massive contraction to the global economy. So what I'm saying is that, in my opinion, there is a 60% probability of a recession in the early parts of 2018 in the US, unless something else happens. Unless something else happens. What could that be? That could be tax, it could be wars, it could be whatever. But the problem right now is that this is in motion. This is happening independently of what the central banks think, independently of what the politician thinks. The amount of credit going into the system, which is entirely built on credit facilitation. Don't forget, every single growth point we had in GDP since the great financial crisis has been financed by credit, not by productivity. The story of Russia, the story of the US, the story of Europe. It's about expanding balance sheets. Okay, so this is the most important thing about this breakfast. If you don't need to listen anymore, now you can just relax. This is the important one. But UBS did a similar one. Again, you see the magnitude in 7-8, very big. This again is the second largest slowdown we've seen. Both our analysis and UBS's is confirming there is a massive slowdown in this credit impulse. Everybody agrees there is a 9 to 12 months lead on the credit impulse to the economy. And it's quite unique. Think about your whole history as economics and finance correspondents. You've never had anything you could use sort of a rule of thumb in terms of what is going on in the economy. Of course, this is not like a printing machine for money or whatever, but it sort of makes sense, right? That you look at what you put into the model instead of look what comes out of the model and put it back into the model. So at least econometrically, we are more honest about what we're doing here than we were before. Of course, there are other factors. There are confidence, political rhetoric, regulatory frameworks, and vice versa. It also dictates. But the impulse, the macro impulse right now is very, very negative for the potential of growth in the world. And if we just quickly translate it into Russia, I mean, the National Central Bank itself says the speed limit in Russia now is 2%. So you know that's the maximum speed they expect. So imagine the rest of the world slow down significantly, and 2% is the new speed limit in the system. We are back to the conversation I've had with a few of you for the last 10 years. We need the mandate for change. The mandate for change is the only way you change any political system, including the Russian ones. And that is not a political statement into the election. It's just a matter of fact. It's a matter of history. So that leads me to say that US interest rate is going to zero. I mean, there's no way that the world can live with higher US interest rates. Higher US interest rate is not only an issue for the US, it's an issue for the world, because 50% of all net debt in the world is dollar financed. And since the great financial crisis, the expansion of not only central bank's balance sheet, but the overall debt structure of the world means that if the dollar goes stronger, then the repayment on debt is more difficult. The emerging market goes down, commodity goes down, and inflation goes down. So the world is now entirely built on credit, and through the being built on credit is entirely dependent on the net change of the dollar year over year. So you can say very, very simplistically, for your readers, for your investors, they only need to know what the net change of the dollar is going to be for the next 12 months, the net change of oil, and how big is the recession risk in the system. The reason why recessions is important is it's only in recession that you have a deflating of bubbles. The average recession in the US, as an example, sees the value of the stock market go down between 25 and 55 with a median of 35%. So if you are an investor, you need to know, is the dollar going up or down? If it's going down, I should be fully invested. If it goes up, I should be careful. If oil prices is rising significantly, inflation risk will take off. That will be good for the top line of companies, bad for the consumer disposable income. And most importantly, recession is what you need to ask yourself every Friday over morning coffee. Do I think the recession risk is larger or smaller than 50%? If it's larger than 50%, you need to be defensive. If you think, like the rest of the world, that all is clear and there's a 10% probability of recession, just go put all your money in risk and pretend that the world will never see as a rainy day again. I'm going to use US examples, but it actually also goes to the Russian market. I think one of the big conundrums we have in the market, why don't we have productivity? Why don't we have innovation in these economies? In Russia you will argue, oh, it's the political system, but it's more than that. It's also the structure of doing business that is changing. So I've shown you an example of capital expenditure. So take Maersk, the world's biggest shipping line, Danish by accident, but in the last 12 months they spent $5 billion on capital expenditure. This is old business, old traditional business. They have a market value of $38 billion. Then take an electronic company like Market Access, the world's biggest bond platform. They, in the last 12 months, spent $8 million with a capital value of $7 billion. So basically, they spent 8% of their value, they spent 0.1% of their value. Why is this important? It's important because you have to understand it's only the old businesses that are capital intensive. So when we look at the capital expenditure, investments, capital formation, as it's called in economics lingo, then we are looking at the wrong thing, because companies today doesn't need the same amount of capital expenditure in the technology side. So what inherently happens is that the capital that used to be spent as capital expenditure, in a classic economic model, the saving there would go to higher wages. But wages is going down. So what happens, of course, is that the profit goes up. So one of the reasons why we have very high profits is not per se that the companies they are successful, they are good, but it's also because the capital exchange structure has changed dramatically. You simply spend less money on the product when you are in new technology relatively to old technology. Unfortunately, you also spend proportionally less money on paying your employees. So a case like Facebook pays nominally high wages, but in terms of the overall valuation and the value of book value, they actually pay less. So you are increasing inequality by using and working for a technology company. And by the way, I am the only one that thinks that the fact that Google have in-house gym and physician and kindergartens, whatever, is the modern form of slavery. I mean, they're making sure you never ever leave your working place. If that is not slavery in the modern version, I don't know what is, but that's a total different conversation. But you can also see in another way, in the way we value companies today. General Electric is 128 years old. It was, by the way, built by Edison. It has more than 300,000 employees. It's worth less than a 13-year-old Facebook with 12,000 employees. This picture, this chart, shows you all of the challenges and all of the upside we have in today's modern business environment. We have a change in the capital structure. We have a difference in how we pay our employees relative to profit, relatively to capital. And we have a total new structure in terms of what company owns the market. But it gets worse. Recent papers, and this is getting a little bit academic, but I wanted to tell it to you because I think it is number one reason why we don't have productivity. So recent research has shown that declining competition and investment in the US is driven mainly by more monopolies in structures. Regulation and monopoly structures in businesses is the main reason we see a slowdown, according to this recent paper. It's done in July. What this model, this analysis is saying is that if you think about the technology companies today, how do they operate? Like Facebook, Amazon, whatever. They don't make any money for a long, long time. What they do first is to create a critical mass of 500 million to 1 billion users. When they have that, they have the monopoly, and then they price their structures accordingly. Facebook and Google today own 75% of the global advertising market. 75%. There's never been a bigger monopoly ever in history. It is bigger than Standard Oil in the 1930s. Do you know who are the single biggest contributor to lobbyism in Washington today? For a very long time, for very good reason, it's been the banking sector. It is no longer the banking sector. It is Facebook, Amazon, Google, Apple, who is the big lobby. And they're twice the size of the banks, who in American terms are seen as the big crooks who constantly is paying out money, right? But look at this chart. This is very important. So this one shows all the businesses that this report looks at, all the different business sectors, and it measures how much concentration is there in terms of business monopolies. And in legal terms, a monopoly is when you own more than 25% of the market share. This is called the Haffindale Index, and it's moved from basically 0.25 to more than 0.5. So more than 50% of all businesses in this survey has monopolistic structures. It doesn't necessarily have monopolistic regulation, but they have monopolistic structures. And that's why we see in the S&P 500, but even probably also in Russia, that the technology company keeps growing in size, and they own the market. There are no alternative. So today the business model is that either you own all of the market or you own nothing of the market. There's very few businesses where there are more than 2 players in the marketplace. And when you add to that you have pro-cyclical regulation, you get even more concentration. So ironically, all the regulators think they're trying to help and protect the consumers, but regulation is shown to create even more monopolies, because monopolies are barriers to entries. You need a certain amount of lawyers, compliance officers, and the likes to keep in business. This is a very important understanding we need to have. And by the way, it's not always enough to have 1 billion investors. 10 years ago, this is the front page of Forbes. Nokia rules the world, 1 billion customers. Today it doesn't exist. But let's back to the monetary policy. So I talked about the credit impulse, so the speed at which we create credit is collapsing. On top of this, we now also have a window into the future of what Federal Reserve wants to do. So from 2018, we will have a negative contraction of the overall balance sheet as well. So you have the flow is down, and now the stock is also down in terms of the credit. But apparently it's all okay because Federal Reserve has been communicating this to us. They've basically been on the Facebook wall and told us that this is going to be all okay. There's no problems. We have only 3 Federal Reserve governors, but everything is good. It's going to be no problem to return all this capital. Of course, this is nonsense. And the last one before we go into Russia is that, as I said earlier on, I think everything, well, let's go one step back. I was asked to do a speech for the CFA Society in Singapore. They were celebrating 30 years anniversary, and they gave me the easy task of predicting the next 30 years. Stupid as I was, I accepted the challenge. I should never have done that, of course, because I realized I can't even predict the next 30 seconds, so who am I to talk about the next 30 years? But doing this analysis, I came up with one thing that is pretty clear to me. If you think about it, everything that goes on in the world is deflationary. Of course, demographics we know of. We know that debt piles, non-performing loan is negative for growth in lending. We know that regulation is negative. Higher policy rates is negative for inflation. Automation and robotics is reducing. But the most important one is this one. Have you realized that inside the last 2 months, China has declared to the world that by 2030 there will be 0 cars in China that drives on combustion engine. I say it again, 0 cars that are driving on combustion engines. Inside the next, not 50 years, inside the next 12 years. Volvo started the game. Geely, who owns Volvo, is a Russian. I wish it was, but it's Chinese company, very close to the leadership. 2020, not a single Volvo car will be driving on combustion engine. BYD, the biggest producer of cars in China, by 2030 there will be no cars. France, always willing to play games. 2040, it's done with combustion engine in France. And even the bloody Germans, who are of course the biggest beneficiary of having a combustion engine, now they say everything from Bugatti to Lambo, every single VW group model will be electrified. Ladies and gentlemen, this is the single biggest industry paradigm shift we have seen in the history of my time. This is about electrification, and it makes perfect sense actually. I'm not going to be the judge whether electric cars are better or worse or doesn't work or does work, whatever. I'm going to be on the fence. I'll let you do that. But when the single biggest market in the world have a pollution problem, the number one social issue in China is pollution. What is the easy fix? That you get electric cars only, right? This is what's going to come out of the party conference in October in China. Then they are going to go for quality over quantity in growth and the way they operate the system. And a big part of that is going to be this electrification. And you can of course see where this leads, because 56% of all oil demand in the world is transport. 56% of all oil demand in the world is transport. And people tell me, well, today there's only 2% of the world's cars are electric. Who cares? China just told you that you either start this game or you don't. Actually, in China right now, if you are producing electric cars, there are 0 import duties, 0 tax on anything. If you produce combustion engines, they're taxing the hell out of you. So like they've done with water, with energy, utility, everything else. What they like, you get to go to do business with. What they don't like, they take away. This is going to revolutionize not only the car industry, and in that respect Germany. Germany is going to have a big gap to fill if they don't get electrified fast. It will be a massive consolidation of cars, because at the end of the day, there's going to be a chassis and a battery. That is what's going to be the difference, right? So I think that is a. But then on to what you want to talk about, Russia. So let me start on the question you're going to ask me, the banking sector in Russia. Is it a problem? Is it going to be worse? Is two a trend, or is it? So I think you can attack this from two sides. Let's start with the economic side. In Russia today, you have negative lending. Actually, you have a credit impulse contraction that is just as big as the one we see in China. If you have no lending, you have no lending demand, you have low velocity of money, you have low inflation. If you expect that to be good for your non-performing loans and your banking sector, you need to go back to economics 101. So a lot of what we see improvement in the inflation and the negative spillover into non-performing loans is predicated on the fact that your lending growth is so meager, so weak, that it will have to happen in an economy with a speed limit of 2%. So I think it's inevitable that you had to face what you faced. I will also say up front that your central bank government is one of the few central bank governments I actually respect. I think early on in her leadership, she was very hawkish when she dealt with the regions and the deficit they had. She was very hawkish in reducing interest rate when she could have been more aggressive relatively to the rest of the world. She was not afraid to stand alone when the US Federal Reserve started talking tapering the first time. So I think she's done a great job inside a very difficult situation. But the economic reality is if you have zero growth or close to zero growth, and you have no productivity, you have less disposable income and negative lending growth, you will ultimately see all these things transmit into the banking sector. So is it a problem that two of the 15 biggest banks has been nationalized? It's not in the short term because, of course, your two biggest banks remain very solid, both in capital adequacy and in this market share. But that is the long-term problem as well, that they are two strong banks, or effectively they are with their VTB 24 and wherever they are more than the two, they are the 3-4 strongest banks, right? You know, having 400 banks being folded in the last 2 years is an issue. It would be an issue for anyone. But the other way to see it is Russia has been overbanked. There's been too easy to be a bank in Russia as well. But I would say short term, I don't think it's an issue. I think long term it is an issue because we are back to monopolistic structures. There are really only two banks now in Russia, and both of them are not in the hands of the private sector. Next question you're going to ask me, should you have a bad bank debt? Should you have a nationalized bank that takes all of these semi-insolvent banks under their wings and do it? Yes and no. I do think you need to look at a Swedish bank model where you take all of the bad structures in, you try to parcel it off to hedge fund and others who want to buy the structures. But making another state bank, I don't think is a solution. You rather want to be having a model where you'll make a special purpose vehicle, which is to amortize all of this outstanding NPL and sell off the good parts and slowly amortize through bond issue and guaranteed by the state. But having a third party in the bank, I think if you do a state bank, the whole purpose of that state bank should be to be out of business in 20 years from now, not to be another player in the marketplace. And I think the resolution to the monopolistic structure, of course, politically it's very difficult considering that there are more sanctions incoming from the rest of the world than we need. So you have to buy time in order to consolidate the banking sector inside no foreign ability to buy in or be enticed. And at the same time, you need in Russia to acknowledge that if you want a competitive banking landscape, which I think is at the root of all good economies, you need foreign banks, you need foreign capital. To do that, you need to have a better, let's put it as it is, rule of law. You need to have more transparency in terms of international ruling. And we need to get back to talking to business people, but that's almost, of course, is a political issue. I think the single biggest issue with Russia right now is the fact that the Senate and the Congress in the US, as you know, is considering imposing sanctions on derivatives and the bond market. It would hurt more than all the other sanctions together, in my opinion. Because as we know, you can live with the sanction we see now, which is partly, but if you start to hit the funding ability of Russian entities overseas, you're really going back to my model. You're taking away all of the credit input that goes into the model. And you can imagine what that would do to the credit impulse. I hope personally that will not happen. I don't think it's the way you do business with each other. But having said that, you know that with a president who is cornered, both in terms of his so-called connection to Russia, but also in his political inability to move the needle in healthcare, in tax plans, in acting out of character very often. I think you could see why politically he would may want to make a stand. I don't think it makes rational sense. I don't think it is good. And I think if it does happen, it will be, dollar ruble in 65, 70. You will see the bond spread go out by 200 basis points. You will see 10 years, which now trade at 7.5, will be at 8.5, 9. Because the 30% foreigners who owns the fixed income market would want to leave all at the same time, in my opinion, if that happens. Especially US fixed income managers who remain some of the biggest in the world. So I'm nervous. So I think I have been very, very, very positive on the ruble for a long time. I think it's done now. I think the dollar side is done short term, but I think long term ruble, there is unfortunately enough trouble incoming. I think gold is going up ultimately. Europe is an interesting story. Quite a few have asked me about Europe, and everybody wants to focus on immigration, which is interesting. But let me address immigration in economics terms as well. Immigration is only an issue if you don't have growth. If you gave all the immigrants a job, you would not, in my opinion, have immigration issues. And what is happening in Europe right now is that Europe is in its best shape it's been in my 30 years in business. And it's pretty clear what's going on to me. So Europe has the highest unit labor cost. It is and was the most expensive place to produce anything. But what is happening in technology now, of course, is automation, robotics, AI. Something Europe is very quick to adapt, very quick to use. So Europe is actually accelerating its exports at a time where you see technology breakthroughs. Europe is the best geographic area in the world to benefit from the industrial revolution of technology. The US is not able to do it. First of all, they have a president who insists on having jobs for the sake of jobs, relatively to creating jobs instead of keeping jobs. And that is a very different agenda. And then the one you're not going to like, I think based on electrification, based on massive amount of potential output in the Middle East, which is being kept in check right now because of the Saudi Aramco IPO, I think oil could easily see $25 in WTI, which equates to about $30 in Brent inside the next 12 months, but certainly inside the next couple of years. Because this electrification will be exponential in its growth, and every single car producer in the world will be backing away from as soon as possible. The incentive structure of governments will be, if you buy an electric car, you're going to pay half the tax you're paying on a combustion engine car. And that's one thing people like. It is a good discount, right? So the amount of electric cars in the world will go from 2% to 10% next year, and then it will be 25% the year after that, and then we are getting very, very close to the levels that you want. This little guy, the Rocket Man, I think, I personally think that October is a very, very critical month. Containment as a strategy has never worked in history. If you have studied any military history, you know containment is the worst of all evils. I think Trump is, and don't forget the number 1, number 2, and number 3 advisor to Mr. Trump. What are they? Generals, all of them. The 3 people, there's only 3 people in the world that, well, there's really only one person Trump listens to, that is himself, of course, but the other 3 people he will listen to are all generals. And they are ready. The US is ready, and I think if it happens, it will be in October, or it will not happen at all. So I think the next 30 days is very, very critical, but that is just a personal opinion. What else do you got? Just a quick through on Russia. It's impressive. Russia has been the best bond market. The spread is 100 basis points. Very impressive move. And what's interesting, it stayed down here despite the threat of imposed sanction. And I think the reason it stays down here is that the central bank has signaled that they are willing to cut interest rate by 50 to 100 basis points. So think about if you are long Russian bonds as a foreign investor, you have some risk on the side, but again, you can get 100, 150 basis points of profit if you stay in the position. So you're willing to give it the benefit of doubt for now. But when this flow moves, it will move very quickly, in my opinion. And here is what I'm just indicating. This is the weekly move in yields in Russia, and we've seen a massive concentration of ever lower yields. So basically, the whole curve is now adjusting downwards in Russia. This is why I said congratulations. This is the first time I come here when things are good. Wages are stabilized above zero. That is good. Inflation is coming down pretty good. And retail sales has turned positive since Q1, which is, as you can see, the first time that the consumer is actually coming back in Russia. So congratulations on that effort. The other story is, of course, that the Russia stocks remains the cheapest in the emerging market. It's actually a 50% discount to the rest of the world. So I would wager if you are a domestic Russian investor, you should definitely be buying some of your own stock market at a minimum because it is very, very cheap. For us foreigners, it's more difficult because of history, because of rule of law to get engaged. So how bad is my $20, $25 call? Well, correlations is actually the lowest it's been in almost history. So the correlation between ruble and the and Brent is actually only at 20%, where classically we operate around 60 to 80%. To some extent, you know this is wrong and this is artificial, right? It is because it's calm, it's because the dollar is weak. So you can say in a different way, you can say everything that should go well has been going well in terms of the ruble, the bond market, the political situation, inflation. So you're getting 5 out of 5 for what will be good for this correlation to go down. But it is very, very low. So it's not necessarily bad that oil goes down $5 to $10. Have a small impact, but the correlation is very, very low overall. And that's kind of interesting. I was very surprised myself, and I can see from your eyes, it's also a little bit surprised to you that the correlation is low. This is technically in oil why I'm negative. What is going on, of course, is that the inventory in the world of oil stocks is going down, putting prices up. But I think it's to a large extent is over now. 52, 54 in WTI, which equates to, with the present Brent oil spread, 60, 62, which should be the top. Let me just end on a happy note. So a lot of young traders at Saxo Bank, they tell me the stock market will never go down. It's never going to happen. I mean, you are very stupid if you are not massively long the stock market every day. First of all, I think I can see the age here. A few of you have been around as long as me, and some not long. So I always pull out this chart. This is the NASDAQ since 95. This is NASDAQ 2000. This drop, ladies and gentlemen, is 75%. 75% of the value disappeared in the space of less than a year. So the fact that people think because growth is up, because people don't understand the credit impulse, because the weak dollar has been supportive, because energy prices has been lower, because the political destabilization in terms of immigration hasn't happened, because CSKA Moscow is getting a 1-1 against Liverpool, whatever, yesterday. All of that is, good, but it is a small period in time relative to what needs to happen. Which is we have to focus on productivity, to the new business model. We have to secure that we have a competitive landscape. So I think on two closing comments, I think in the old days, the fight was between socialism and capitalism and all these branches of economic models. I think today, the only thing we really want to concentrate on in terms of ideology is to have a proper, real price discovery. If you have a price discovery which is fair, unbiased, then we can navigate the market and we can operate. It's not about capitalism or socialism and this model and quasi-model. It's really about the ability to fairly assess the future inflation, the future interest rate, the future price of travel. Think about it. all these buy airline tickets cheap, we think we're getting the best price. What we're getting is an algorithmic function that tests how many times you've been in. Every time you come back, the price is higher. There's not a single search engine in the world who are based on price discovery. There's not a single market today where price discovery happens at the free will of the agents that operate in the market. So my advice to investors will be the following quote by JP Morgan. He was asked once, "Mr. Morgan, how did you become rich?" And his answer was, "I took my profit too early." And that would be my advice to everyone right now. Take the profit early and react to what is essentially a very good story. We are transforming away from economic dogmatism. We are translating away from central bank dogmatic approach. The credit fueling is stopping. We're actually going into a better period, but it is a period of change which no one likes. Thank you very much.